Okay, welcome everyone to this live stream. Firstly, let me thank Private Markets Group for organizing this event. My name is Patrick Boyle. I'm a professor of finance at King's College London and Queen Mary University, both universities in London. We have Ron Diamond here of Diamond Wealth Strategies, and we have Martin Schmalz of Oxford University. Um, so I'll firstly tell you guys a little bit about me. I'll mostly just be moderating the event today. But yeah, my name's Patrick Boyle. I teach finance, a lot of derivatives and that sort of thing at the two universities. And I have about a 25-year work experience in finance, mostly hedge funds, quantitative trading, that sort of thing. And I run a reasonably popular YouTube channel as well called Patrick Boyle. I thought I'd give it a catchy name. So let me put. I'll introduce Martin Schmalz. If you could tell the audience a bit about yourself, Martin.
Yeah, so thanks very much for having me as well. My name is Martin Schmalz. I'm a professor of finance, economics, and real estate at the University of Oxford's Said Business School. And the reason I'm here is because I teach a course in wealth management and family offices at Oxford. I've been helping families set up family offices and run them for about a decade or so. Um, Set up a hedge fund as well in the past. And since then have just observed uh, what are the causes that some families lose their wealth or don't manage to preserve it, even when that's their objective. And got quite passionate about this and want to talk about this today. So I look forward to the discussion with you and Ron.
Excellent. And Ron, can I ask you to introduce yourself as well, please?
Sure. Well, thank you for having me. And Martin, great to see you again. Um, I have a syndicate of about 124 families. These are family offices, anywhere between 250 million to 30 billion. And we just invest together in the private market. So that's private equity, venture capital, real estate, credit, sports teams, et cetera. I also sit on some advisory boards, and I put together the family office initiative at Stanford and at University of Chicago Booth.
Excellent. Okay. Well, I guess our first topic we want to talk about today is investment strategy, asset allocation, and governance, all of which I know Martin is quite an expert on. And I guess the first topic we'll bring up is just this idea that you just mentioned, Martin, of how often the first generation can generate a huge amount of wealth that then doesn't seem to pass down the generations as well as would be expected. Can you elaborate a little bit on that, please?
Yeah, so that's right, and I didn't exactly invent that statistic, no, but I have checked on it when I saw this discussed, including on Patrick Boyle's excellent YouTube channel. So right, so one exercise you can do is to take a Forbes magazine and look at the list of the richest people in the US or the world or whatnot, and then check again 20 years later how many are still there. And it is a tiny fraction of the same people reappearing, right? And you say, well, that's kind of strange because don't I read that the rich are getting richer all the time? And that's true for the top percentile as a statistic relative to the rest of the population, but it's not true for the individuals that are in that 1%. So people flip in and out of that group quite a bit. Right. And so the reason this is perhaps surprising is because, right, so world market cap of public equities or bonds has gone up over that time. So it seems like an unarguable fact that people would have stayed in their wealth decile if everybody just invested costlessly in a broadly diversified portfolio. Now, which is, of course, what the finance professors teach right in that as a baseline. No, there's nuances to everything I'll say today, and we don't have time to get into all the nuances, but as a baseline, you'd say if people invested costlessly in a diversified portfolio, it's not possible to lose wealth as quickly as people do, which makes it a bit of a puzzle, doesn't it? No? It makes it a bit of a puzzle of what exactly are they doing that makes them, well, some of them but that makes some of them earn higher returns than the market, right? But most of them not. And why do they do it? And so this is what I'm trying to get on the bottom of. But yeah, so that's the motivating fact that people tend to, or families tend to lose their wealth within a generation or two, although that seems like an avoidable scenario.
Well, yeah, I mean, the statistics are 25% of families make it to the second generation, 10 to the third, and 5 to the fourth. So the model doesn't work. Family
It's
offices in general are very fragmented, very inefficient, and very siloed. But question for you, Martin. When people come off the list of the Forbes, um, don't can't part of that be from they're doing good estate planning and they're getting money out of their estate, and because of that, couldn't that be part of it?
so absolutely, right? And I mean, that's just mechanically true. So let's start with what's clearly true, no? So I'm a billionaire, I have 1 billion to invest, and I have two children, then clearly, if I just split that wealth among two, then there's only half as much left, no? So now let's see how quantitatively important that mechanical effect, though, can be, right? So if I invest at 7% a year, say, some sort of broadly diversified portfolio, maybe that's a realistic number. If I compound at 7% a year, then my wealth doubles within 10 years, roughly speaking, right? So it quadruples within 20 years. So even if I just have two children and I have them at intervals of 20 years, the per capita wealth should still double for these children, right? So, and then usually people have kids more than in their 30s or maybe even their 40s. So that doesn't seem to be the quantitatively important reason. And similarly, I said to Patrick, I could get two divorces over a period of 40 years and lose half my wealth and still double my wealth over the same time period just by diversified investing. So clearly, I mean, the answer to your question is clearly yes. I mean, if people consume a lot and they have lots of children and they split it up, clearly that's mechanically true that this is going to dilute their wealth, but I don't think it can explain why their real wealth declines relative to the market portfolio. So it must be investment mistakes of one sort or another. And I should say, when I say mistakes, of course, implicit is that there must be an objective. So I'm saying if the objective was to preserve their wealth, then clearly they're making mistakes, no? If they say my objective is to maximize the probability that I become as rich as Elon Musk, then obviously they should just be holding leveraged bets on single stocks or I don't know what, right? Or just buy lottery tickets. But if the objective is to preserve the wealth, then it seems to me that there must be investment mistakes involved, and it cannot just be these mechanical effects of the estate splitting up among multiple
Well,
people.
I think the classic example of this is Victor Hagani's book, where are all the billionaires, where he looks at the Vanderbilt family. And I think in 1900, Vanderbilt was the wealthiest man in the world. I feel it was about 10 or 15 years ago, the story goes that his family, all of the descendants, the Vanderbilt descendants, met up at Vanderbilt University for a family picnic. And during a conversation, they worked out that none of them was even a millionaire at that point, right? So, I mean, the greatest fortune in history, or at least in history at that time, entirely vanished. I think the wealthiest member of that family is Anderson Cooper. But that money came from, he made it himself with his career in television. His mother was, I think, Gloria Vanderbilt, who had the fashion business in the 1980s, Vanderbilt jeans. And I believe he tells a story of how his whole family, his mother included, just sort of spent money like it was water with this idea that it could never go away. And then one day it was all gone. And I'm reminded another Victor, I used to work for a guy called Victor Niederhofer, a well-known fund manager. And Victor used to talk about how there were certain people who lost money, at a surprising rate. Like he would point out, like if you look at gamblers, we'll say at a horse track, statistically speaking, based on how many bets they made, they should only be losing a certain amount of their money and they should walk away with, a reasonable amount of the stake that they brought there that day. But he said essentially everyone leaves penniless. And the problem is, it's not even that they're not doing the right thing, but they're specifically doing the wrong thing. Like it's almost like if you think about the Vanderbilt fortune, like I mean, it's not just a minor slip up that such a huge fortune entirely vanished. It's because even just one family member doing the right thing, it would have worked out. So, what are your thoughts on that idea about people almost just doing like going sort of so far wrong that it's hard to understand?
Well, it's interesting because right now, first of all, back in Vanderbilt's time, the time it took to create wealth was generations. Now you can create wealth with an app, and literally in a year or 2 years. So that time frame has changed everything. And what's interesting, what I find, and we have a syndicate of about 124 families that just because you sold your company for $5 billion, your widget company, doesn't mean you know anything about real estate or private equity or venture capital. So you've got huge amounts of capital in what I'll call in general inefficient hands. And it's the ego of the founder, the matriarch or patriarch, in my opinion, and I'm correct, that drives a lot of these decisions because you made $5 billion when you sold your company and you're getting high fives from everybody and you were making glass doors. A lot of people think that then they could, by definition, recreate it. Ty Warner is a perfect example. He created Beanie Babies. He's a brilliant businessman. Sold it for a couple $1 billion. Well, he's brilliant, so now I'm going to buy the Four Seasons Hotel, and he got clobbered. That's an example of what's wrong with what's going on right now. Too much money in inefficient hands, driven primarily, in my opinion, by ego.
So it's kind of a lack of diversification and excessive risk taking, essentially, like all the eggs in one basket, and that basket can uh, blow up on you.
Well, Martin, what's your thought about? I mean, because I think that truly, I think, and people don't talk about this, but it is the ego of the matriarch or patriarch, in my opinion. And again, I'm fairly confident I'm right, that drives a lot of these bad decisions. I'm curious on what your thoughts are.
But look, I work at Oxford, which is an English institution, so I have to choose more polite words to say the same thing. But so the um, so let me respond to this in two parts. One is just describing objectively what people do that lose their wealth, on average, right? Statistically speaking, and then speculate about what the why is. Why do they do that? No? So, I mean, what they do is, yes, they don't diversify their portfolio. And let's be clear about what that means. I mean, technically, that means holding a value-weighted portfolio of all the assets on planet Earth. Now, it turns out that's hard. So half of that is real estate. And one of the things that keeps me up at night is to think about why is it so hard to diversify into real estate, right? And, there could be syndicated options or funds of funds and all these good things, but it turns out to be hard. And if you invest in there, it's unclear why you should reap the returns as opposed to the middleman that organizes the whole thing. So what people end up doing is to concentrate holdings in particular areas of real estate. So they're way overexposed to real estate in Riga, while being completely hence underexposed to Nvidia stock or whatever is actually driving the market. No, so the totality of private equity in the world is what, like about 10 trillion? Is that about right? That's two Nvidias. No, so if I want to build a value-weighted portfolio, technically, then I should be holding a lot of public markets and quite little of private markets, unless I have good reasons to deviate from that. There exist good reasons to deviate from that, such as I have particular skill to identify good private equity managers. Or, I believe that there's an illiquidity premium for holding these private companies and so forth. And we can talk about this. But I'm just saying, as a benchmark of holding a diversified portfolio, people tend to not do that by overweighting particular exposure to real estate, particular private equity funds, as opposed to a diversified exposure to lots of funds. Of course, they have lots of direct investments. Often the Glassdoor company that Ron just mentioned, that is still a bit of a legacy asset or so. Then, of course, there's actively managed funds. And of course, there exist good ones. Like if your fund manages it manufactures tax losses for you, of course, that creates value for you. And I'm not saying that is necessarily bad, but on average, actively managed funds, of course, do not return as much as a as a passive portfolio. We've known that for a long time. So people make all these mistakes. They fall victims to frauds, right? So here and there, especially in real estate and private markets, there's frauds quite frequently, as compared to public markets, that is. That's only a problem if you're not diversified. If you held a diversified portfolio, you could fall victim to all kinds of frauds in public markets. It wouldn't really make a difference, no? So yes, that's what the mistake is. They don't diversify effectively. That's one reason. The other reason is they have no idea how important costs are for their portfolio, right? So the quiz question I tend to ask people is, before fees or before costs, you make 7% a year. Okay. How much do you have after 40 years? So one generation. So there's a FIST formula for that, but I can never remember it. So I always have to use Excel. So the answer is if you invest a billion, you should have 60 billion at the end of 40 years if you held it without costs. If 16, is that what I said? Anyways, if you invest at 5%, so you have a 2% cost of your fund manager, your custodian, your trustee, your withholding taxes, whatever, eating 2% per year out of it, you have half of the amount you would have held with 7%. So a 2% difference in returns, no matter what your pre-cost returns are, a 2% difference returns eats half your wealth within a generation. And I don't people understand that. So people are not cost conscious enough. Actually, most family offices I talk to, maybe I talk to the wrong family offices, but most family offices I don't talk to, they don't even know what their costs are, their annual costs are, because it's just intransparent. No? So those are the two big mistakes I see: a lack of diversification and lack of costs. And I'll let Ron respond before I get to why I think that happens.
I would also add that what happened is there is no playbook, right? So you have a liquidity event, you sell your company for $5 billion, people start investing right away. Okay. That's not what they should do. The first thing they should do is something called governance, then put together a mission statement, then put together succession and next gen. Talk to your estate planning attorney is going to be more important than many of your money managers because that's the structure of everything. So right now, and one of the reasons I helped to create this family office initiative at Booth is just to do this, because once you've had a liquidity event and you've sold your company for a lot of money, there is no playbook to say, okay, well, don't invest. But all your friends are hitting you up because you made a lot of money, it's in the paper, and they start investing, and that's like the wrong thing to do. The other thing that I would say is, the people, what's shocking to me is that most family offices, they focus on return. Most of them, not all of them, most of them don't focus on after-tax return. I don't care if Citadel's up 20%. I just care that Citadel's up 12% after tax. Period. And that's something you've got the accountants in one room, the investment managers in another room, the lawyers in another room, and they don't get together. So it's not a cohesive platform. And I think by getting everything together, what people need to do, again, you need a quarterback to do this. It makes a huge difference. So the leakage people are getting from not doing it, not what I'll call structural alpha, how things are structured, they're getting crushed in the taxes.
Yeah,
So that actually helps us transition maybe to just that idea of kind of tax-aware investment. Like, what are the tax strategies that wealthy people should follow in order to maximize their wealth?
Well, one of the interesting, I was at a conference. I run the family office group for Tiger 20, one of the family office group for Tiger 21, and we had a speaker, and the speaker was from AQR, which is a $185 billion fund, and they're doing tax-aware investing, and they're literally growing at $3 billion per month right now. And it's shocking to me that this is like such a novel concept, but people didn't focus on this. In some of the CIOs of the family offices are paid pre-tax, which is insane. So you've got to have alignment of interest. And I think part of the reason why firms like AQR are doing so well is because people are just starting to understand the word structural alpha is going to be commonplace in the next several years. Before the last couple of years, sure, Martin knew about it and Patrick, you knew about it and I knew about it, but most people didn't. And I think that the structural alpha, how you structure everything, is as, if not more important than the actual investment.
So let me just add a few words of agreement here. So regarding the point of that people just start investing, right? And that's true whether you just sold a company or it's just fantastically profitable and spits out dividends, no? Like, so why does that happen, right? And I so the more polite way of saying what Ron did is I'd say people confuse the discipline of wealth creation with the discipline of wealth preservation. And I don't profess to have a lot to say about the first discipline of how to build a glass door company. No, I'm only can speak to the second discipline. But it takes a lot of humility to recognize that those are different disciplines that require different skills, different knowledge, and maybe reward different types of personalities. No? And so here we come to what gets rewarded in investing versus in entrepreneurship. So as an entrepreneur, it doesn't hurt you to react quickly to new trends. COVID happens, fantastic. We now need to manufacture face masks, or I don't know which medical tool. Let's switch our production around. It's a great trade as an entrepreneur. If COVID hits, stock markets drop, and your first impulse is we need to sell equities and immediately get into bonds, that's probably the worst thing you could have done because 2 days later, Congress passes some sort of bailout package, stock markets rebound. By the time you calmed your nerves and you're back into the market, you miss out on the rebound. So what you do is you sell low and buy high. And well, guess what? That eats returns. That's not a very good strategy for wealth preservation. No? So the same impulse that might help you as an entrepreneur is an impulse that really hurts you as an investor. And it could count you 15 other examples of investment mistakes that people without the proper training make that would actually be helpful in the different discipline of wealth creation and not teasing these things apart. I think that's a big part of the problem. Now let's get compounded by really, really bad advice, right? So there's these human biases out there, but then there's an entire industry that makes a lot of money by furthering these biases rather than standing against them and checking these biases. And what Ron said about the first thing you should do is to set up a governance system. That is basically the mechanism that keeps people in check, right? So that says, hey, look, we have an investment policy statement that says there's buckets, here's our asset allocation, and we stick to it. And unless there's a board meeting and you fire all the board members, you cannot change the asset allocation. So you want to build friction into the system in order to check people's impulses and to take these emotional decisions out that lead to these investment mistakes that destroy the wealth. So this is just me agreeing with Ron that the first step is to set up this governance structure, including the tax, including a proper accounting system that enables you to actually see what the costs are, including the taxes, the running taxes that you're accumulating with your investment strategy.
And then you've got the alignment of interests, right? I mean, what people don't focus on, I mean, you've got all of these people who are trying to sell into the family offices, private equity, venture capital, real estate, whatever it is, and they're incented to sell, right? And most of the family offices aren't experts in that particular vertical. So I think that you're going to see a change, in my opinion. I think we're at an inflection point because to me, the biggest advantage that family offices have, very few families utilize, and that's something called patient capital. So the biggest advantage family offices have is they don't have the way the private equity model is built today is when somebody buys a garage door company in London, I could tell you about when they're going to sell it, not because I'm so smart, but because I know how they're compensated. They're going to sell it in about 5 years. And then what's going to happen? They're going to probably sell it maybe to a strategic, but probably to a second private equity firm. So if you look over the course of 20 years, this one company is going to change hands, let's call it 4 times. If you look at the taxes and you look at the friction and you look at the disruption in business versus a family office who could simply buy it, hold it, and let it compound, the results aren't even close. It is objectively a better model. The problem is very few family offices can execute and understand how to do this. So the biggest advantage they have, most family offices aren't taking advantage of. I think that's starting to change. And I think as private equity and venture capital disrupted the public markets in the late 80s, I think family offices will never replace, but are going to start to disrupt the private equity model because there is a disalignment of interest. And it's become private equity in not all cases, but in many cases, it's become an AUM game. And you need to operate in order to create alpha. I could financial engineer any company and make money in 5 years, but it's not going to do well in 15 or 20 years. The family office is the biggest advantage is patient capital and the fact they can operate. And most of them don't do that. I think that's going to change though.
Now, do you see family offices with the desire to run businesses like that? Because I almost think the biggest reason they might choose to put their money in a PE fund that might run a garage door company rather than buying it themselves is the lack of knowledge as to how to run a business like that, and also maybe just the lack of desire to be in the weeds of running a business.
That's correct. But if you're going to set up a deal team, right? So if you've got a family office with worth, let's just say $10 billion, you've got plenty of capital to set up a deal team. There you could take advantage of what you have, the advantage that is patient capital, where you don't have to constantly sell. I think what's happened is many of the private equity firms have bastardized the business. And I could say that because I'm from America, I'm not from Britain, so I could say that word bastardized. But they have, and it's become an AUM game. And I had a friend who did a roll up of logistics companies. He needed $150 million, and the placement agent got him $500 million. The placement agent comes to his house and said, and my friend said, "Well, I just need 150." The placement agent writes down 2% of 500 equals X, 2% of 150 equals Y. What am I missing? And my friend looking at him incredulous, he said, "Well, if I do what you want me to do, there won't be a fund two because I can't deploy the other 350 million." That's a microcosm of what's wrong with private equity in general.
Mm.
So I want to dig in there, Ron. So because I like your point, I mean it's just objectively true, right? So you have patient capital there, and you would have the ability to overcome these frictions. Um, and right, so I'll add to the list of things that are useful in owning a private company, which is emotional attachments to the company, or even identity is attached to the company. And I say that's not useful as an investor because an investor is just going to sell an asset if it no longer makes sense, no? So there's this tension here, isn't there? That the same traits that might be useful to run a business or to create one um, also come with a potential pitfall, no? So you said they have patient capital, but not the ability to operate. I mean, if they're over optimistic or overconfident about that, or their ability, their willingness to take idiosyncratic risks, the entrepreneurial courage that comes with that is all necessary to run a company and a trade, but it also opens them up to vulnerabilities. And the question is just whether people have the, I guess, self-knowledge to distinguish whether the pros overweight or the cons do. But I'll go back to the basic factoid, which is it seems like the majority of those people who try to hold an undiversified portfolio end up losing their wealth. Or do you disagree with that? Or is that where we come out on the balance, or where do we come out on the balance between these pros and cons?
No, I think you're spot on. And there's a lot of different reasons for it. You just highlighted several of them. But again, you've got huge amounts of money that's been generated I mean, 68% of the family offices that exist started since 2000, and half of those started since 2008. So this is a relatively new industry. When you look at not in Europe, there's obviously 25 generations you can go back, but in totality, 68% of the family offices that exist started since 2000, and half of those started since 2008. So this is a very, very new industry, and it is fragmented, it is siloed, it is very inefficient, and it's just not run properly. And there has to be a playbook, and that's why we're trying to do it at Booth. I mean, you go to these family office conferences. I mean, Martin, you've been to several of them. I keynote many of these conferences, and the investors who invest with me say, "Should I go?" I'm like, "No, it's a pay to play model. It's like if Patrick's speaking, he's just spent 25 grand to speak. Not that he might be good, he might not be good. That's not a good model. So we have to reverse that. So even the family office conferences, which are all over the world now proliferating, there's a conflict of interest because they're paid by the sponsors. So I think it has to come, in my opinion, from academia, because in academia, we don't have, like at Booth, we don't have to make profit. So the conference we put together, we had Nobel Prize winning professors from University of Chicago Booth speaking on what they think is going to happen with tariffs or interest rates. They had no agenda. They weren't trying to sell anything. And I think it all comes back to alignment of interest. And because there's so much money involved in family offices, um, you got all these, every accounting firm, every law firm, every bank, they're all opening up these family office divisions. It's optics.
But
Tell
Ron,
me
so,
this, because
yeah.
I would imagine one of the real struggles of setting up a family office is just hiring well. Because even when you think of the incentives of the people you hire, you're going to bring someone in, and are they going to say, like, let's put you in a 60-40 portfolio of, diversified basket of stocks and bonds, or are they going to come up with something fancy? And I would argue that they'd have an urge to come up with something fancy because no one's going to pay you well to put them in the Vanguard
So let
fund.
me let
I
me
think
touch on
that's
that
the
for a second.
paradox. Yeah.
Yeah, let me touch on that for a second, and then Martin, I'd love to hear what your thoughts are. Right now, most family offices, compensation is a big problem for family offices because right now, most family offices, if they pay a kid out of Stanford $250,000 a year, they look at that as a cost. In other words, this cost me $250,000. I promise you, if KKR or Blackstone hires a kid at $250,000 from Stanford, they look at that kid not as a cost, but as a potential $20 million profit center. So it's nuanced. So you need to do it. So once you've got to get your head out of the fact that this is a cost center and a profit center. And some families get that. Today, most don't. I think that's going to change. What's your thought, Martin?
So look, Patrick, I think you just put your finger on the paradox here, right? So if people gave this extremely boring advice that these academics have to offer on how to preserve their wealth, that doesn't seem to be sexy enough, no? So my point is that I mean, clearly, these people you'd hire would give this kind of advice if there was demand for it. So I think we're going back to Ron's point and say, well, if the recipients want to, have a big ego, Ron's words, not mine, then of course it will.
You hold on. You said you circled
At this
around it
point,
and
all right,
used
okay, I
your
own it.
words too.
I own it. I own it. So, right. So they don't demand that. They want to be told that they are among the 5% who can beat the market if they invest in
Mm,
this active fund. No, so they want to have these, I'll call it misperceptions or these misconceptions, this over optimism. They want this to be furthered rather than not. No, so some people they ask me which service does a private banker really give me, right? And I say, well, it depends on what's a good private banker or a bad private banker. So a good private banker, for example, is going to prevent you from selling your stocks when they drop during the COVID crisis. A bad private banker will comfort you and say, oh, that's exactly the right decision. And by the way, I take a 0.2% commission each time I transact with you. And I'm going to sell you out of your equity portfolio, shift you into bonds, and do the same thing backwards 4 weeks from now. No? So that
Charlie,
is, I think, exactly the problem. That, the question is that some people are there for the money, and some people are there because they actually care about helping the family preserve their wealth. And going back to your question about hiring, I think the key difference is, you have to find the ones that actually care. And it's extremely hard to find an incentive system, a pecuniary incentive system to select for that. Because how exactly do you incentivize someone for creating wealth over a 40-year horizon? Like,
mm.
are you going to vest the pay
oh,
for 60 years? That's not going to work out. No? So
I
I
mean
think it's
Charlie Munger.
unbelievably hard. Yeah,
I think Charlie Munger had it right. He just show me the incentive, I'll tell you the outcome.
that's
I
it.
mean,
That's the summary.
Mm. Well, there's a number of audience questions that have been submitted, so let me cut to a few of those. The first question I have here is, how do investment horizons differ across asset classes when building generational portfolios, and how does this affect allocation to private versus public markets?
I'll defer to the professor to start.
All right. I'll start and say, just very broadly speaking, if you have shorter horizons and you have a bill come due in a month, then you need to make sure you have enough liquidity for that. And that is going to tilt you further towards fixed income securities than more volatile equities. No? Whereas if you know I have the ability to stomach the volatility, and my objective is to bequeath wealth to my children and grandchildren in 40 years, when I know I have this kind of horizon, you want to be way more in equities and much less in fixed income as a general rule of thumb. And obviously, private equity does require longer horizons. You don't want to be the person who has to sell a private equity stake in the secondary markets because you have liquidity needs that you didn't foresee. So that just mechanically is going to tilt people with longer horizons more into private equity than those that have shorter horizons. But happy to be complimented here by
I'll compliment you, but you did say ego before.
compliment, not compliment.
So look, in my opinion, I think that what you said is spot on. I mean, I agree with everything that you just said. And the the way in which family offices are investing right now, because there is no playbook and because the incentive structure is off and everyone's incented to find the really wealthy people and sell product into them, and they don't know who's the good guy and who's not the good guy. And I think that's part of the problem also. I think I do think we're at an inflection point. I do think that, more and more of these large family offices are going to become more and more sophisticated. And like when the Pritzkers or the Crowns or the Gates or the Dells, when they compete against KKR or Blackstone, they have a competitive advantage because they've got a team of 65, 70 people without a shot clock. And
Mm.
the private equity, they've got a shot clock, and that's a disadvantage, medium and long term for the family. Short term, yes, you could make money, but if you're going to hold it for 20, 30, 40 years, all you want to do is let things compound. And interrupting compounding is the biggest wealth that detracts from wealth. And that's what Charlie Munger said, and that's true. You
And
just
I
want to let it
immediately
buy it.
agree with that.
You want to buy it, let it compound.
Well, an interesting, sort of side point to that is the question of how well, investors are, how good are they at taking advantage of the time horizon they have? There's a great example. I think it was in around 2009. I met with a guy. He was managing the endowment fund. I wonder if Martin knows this story. He's managing the endowment fund of the colleges at Oxford, and he said, "Well, look, we have an infinite time horizon here." And so he said, interest rates are zero. It's, credit crunch had just happened. Interest rates have been zeroed out. Um, we think in the long run that equities will, we're taking a very long run view, and we think that equities will outperform, a zero interest rate in the long run. They issued a bond, double levered the endowment, plowed into equities. They happened to do this at a very good time. It was, during the credit crunch. So I imagine have made massive returns since then. But actually, it was just a very logical way of thinking, that if you have the time horizon that a university endowment does have, and that difference between interest rates and the earning yield of stocks, it was a very sensible thing to do. But equally, would have required great bravery because, if you did this at we'll say like a mutual fund company or something like that, after 2 bad months, you'd be fired and someone would undo your position. So, how good are families at actually taking advantage of the time horizon that they reasonably have?
I would argue that very few are. I would also argue that more and more will be able to, because once they really understand it, they're creating a company, creating wealth is a completely different thing than having the wealth and growing it and compounding it. And
Mm,
they're two completely different skill sets. So I think that right now there are very few family offices that are taking advantage, like the Pritzkers or like the Crowns or like some of these families, large families in Europe that are taking advantage of the fact that they could buy it, hold it, and let it compound, and they put together a deal team, give them the right incentive, the right compensation package where everything's aligned. I think more and more will do it. But right now, and Martin, I'm curious in your thought, I think it's very few who do what probably you would do knowing what you know.
No, so I very much agree. So Patrick, what you described is exactly what one should, of course, do if one has this long time horizon. But it takes an unbelievable amount of conviction in the numbers and in analysis and in a system and distance to one's feelings because it feels not good to anyone to
yeah.
buy equities while they're in free fall and all the screens are flashing
Mm,
red. No? So
yeah.
it takes an unbelievable amount of distance and discipline. emotionally speaking. And again, those in many cases are not the same characteristics as those that help
Grow
the
the
individual
wealth.
to create the wealth in the first place. So they tend to be not very good at it at all. So instead, it turns into a vulnerability because it makes them open to sales pitches that say, hey, look, I'm not going to tell you what the performance is for the next 15 years, but give me the money right now. No. So it opens one up to a vulnerability at the same time. Now, they exist. They exist, these examples, but they're
They're
rare.
rare.
I mean,
Yeah.
and another point is that people sometimes overestimate their time horizon, and the university endowments are a good example. So if I read the headlines over the last year or two of the US Ivy Leagues, they're realizing that in fact they don't have infinite horizons, but they actually have bills to pay, and they find
Yeah.
themselves in the secondaries market right now because their portfolios are way too illiquid for what their actual spending needs are.
Now, this leads reasonably well into our second audience question, which is how do you manage risk when different generations have different risk tolerances? I think that's probably a good question for Ron.
It's a really challenging question, and that's part of the reason why 25% make it to the G2, 10 to G3, and 5 to G4, because they're not really aligned. The matriarch or patriarch who created the capital and put blood, sweat into the company he's done something for 30, 40 years, and this is his thing. The kid, if I see a Ferrari outside of G2, I typically won't invest in it because, and again, I'm not knocking Ferrari, but actually I kind of am. But what happens is if these kids are entitled, like the worst thing you could do is to raise these kids who are when you're dealing with this kind of money with billions of dollars, it's hard. So some of the people, G2, they're worth $3 billion. That's more money than their great go five will ever need. And yet some people will have 3 billion and they want to grow it to 10. And nobody's right and nobody's wrong. But you have to be in a line, you have to be in line with everything. So if there's a difference, if G2 wants to be really aggressive, but G1 wants to be really conservative, that's a lack of governance, and that's where everything has to start.
That leads to our next question, I guess, which is what governance and decision-making frameworks work effectively in family offices managing $250 million or more of assets?
Yeah, look, I'll tie that to the previous question. So I mentioned previously that, people need to come up with an investment policy statement with governance frameworks and be clear about what the objectives are. Another question is going to be, how do you deal with philanthropy? Well, some families think those are individual issues. Some families put this in the family office. Some people think of the family office as just having the function of managing the wealth or a portion of a wealth. Others think it involves managing the yacht as well. So people have to get agreement on the scope of the family office to start with. But based on that, they just need frameworks that govern the investment process and that put this friction into the emotional decisions to make sure that there's consistency across time, so over time and across generations. So, for example, having different investment buckets to say, hey, look, I understand I should diversify, but that's no fun. And I say, well, no problem. Then I have a diversified bucket and I have a fun bucket, for example, or have a bucket that is good enough to protect you from the worst cases where you put your 3 million in or whatever you think you'll need to actually survive if everything else fails. So those are good frameworks. But the way I'll tie this to the previous question about the different risk tolerances is as follows. I should have got myself permission to name the family office, but there's a guy who runs one in Europe that has about like 90 or so family members, and he managed to achieve consensus among 90 family members, which I thus far thought was an impossibility. And the way they do it is he just says, look, I'm going to source your private equity deals. I'm going to build different portfolios of private and public equities, of bonds and so forth. Those are, say, 5 different portfolios, but each one of you gets to choose the parameter of how you mix between them. No? So those that have high risk tolerance, long horizon will choose a greater equity allocation. Those that have a lesser risk tolerance or a shorter horizon will choose the more fixed income portfolios and choose that parameter by themselves. No? And this is one way of dealing with heterogeneity in general that people just choose these parameters themselves, whereas the portfolio construction that requires the expertise that few of the family members will have is still centralized. So that's one way of doing it.
Mm.
Yeah. And what was
Now,
interesting, what I saw, what was interesting is post-crash, pre-COVID, everything went up, right? Private equity, venture capital, real estate, credit, interest rates are zero, Bitcoin, whatever you invested in. So a lot of these families said, well, you know what? I'm going to invest direct because I don't want to pay the 2 and 20. And they were right until they were wrong. And then about 3 years ago, when they started jacking up interest rates, now a lot of them are over their skis. So I think how this is going to play out is a lot of these family offices, um, which I've always argued 85 to 90% objectively, in my opinion, and I don't judge, but objectively shouldn't exist. They're better off in a multifamily office, but the bigger family offices who can really get sophisticated and understand it will get larger and larger. So I think how this is going to play out, the smaller, less efficient family offices, which are many of them, are going to morph into the multifamily offices, and the larger family offices are going to get larger and larger and be able to compete better with Blackstone, Carlyle, and KKR than they currently do.
mm,
So I agree with that as well. And let me just give a model for this, right? So, I mean, effectively, you set up a hedge fund, no? If it's about public equities, the governance mechanism is called liquidity. You withdraw your money after a week if you don't like what they're doing, no? And so that's one way of setting up a multifamily office that would have the ability to generate to form a diversified portfolio, and people can invest in it pretty much frictionlessly, right? But again, that requires that people have the discipline to actually stay in, and so they need their own family-specific frameworks, even if they invest in a multifamily office, so as to make sure that they have a consistent strategy over time. Because the lack of consistency is what, according to Charlie Munger, Ron Diamond, and myself, is eating the long-term returns because it disturbs the compounding. And worse than that, people tend to be positively bad. No, so again, because they sell out when volatility is high, they get scared. My first published paper has the label anxiety in the title, which simply refers to people get scared. People get
Well,
mm,
scared. That jacks up their risk aversion when volatility is high. It causes them to sell them precisely at the wrong time. It's not just that they interrupt the compounding, they actually make positively bad decisions unless there's a governance framework that basically ties their hands and forces them to take risks precisely at those moments that they feel, that they find it least compelling emotionally speaking.
I mean, it's fear and greed, right? Fear and greed drive everything. And part of I believe that part of the reason that some of these private equity firms do better than some of the public companies is you can't sell even if you want to, right? You're forced to hold. So it would almost be better if people were like, you're forced to hold. You're forced to do what Martin knows and Patrick, is the right thing to do, and not if there's COVID or if there's a financial crisis or whatever, sell everything, which is the exact opposite of what you should do. So it is fear and greed, and it's emotion.
it reminds me a bit of the Warren Buffett argument. I think he's put this idea forward that if an investor at the start of their career was given, a punch card and they get to make 20 decisions in their entire investing career, how would they, what would those decisions be? And it's probably an awful lot different than, each time you punch, that's one less. You might make better considered decisions than you do when you have an infinite number.
Yeah, I think that's exactly right. So again, because of course every trade costs money, there are commissions, there's slippage and so forth. But the main problem again is that people are not really good at that. People think they are good at timing the market. There's lots of managers out there that claim to be good at timing the market, but the evidence of that is rather limited. Let's say this in English polite terms.
Now, another audience question, which is probably a good one for Ron, is what are effective approaches to preparing next generation family members for stewardship responsibilities, particularly around private market investments?
I think it comes back to education, and you need to educate these kids. So, you're born into a family, and if your family is a multi-billion-dollar family, this is just the reality that you know. And so, in order to steward that capital with the next generation, you really need to educate. And there are organizations like Nexus which deal specifically with next gen people. But I think that the next gen, it all has to do with education, and it all has to do with people understanding, because people are the family offices, they've got one hand on their ear and one hand on their wallet, right? They're listening to what people are saying, but they're also protecting because everyone's trying to come after the money that they've got. In order to have an effective second gen and third gen, the answer is education. Now, there's psychology involved in it, and there's a whole bunch of family dynamics involved in it. And because people are people, nothing's ever completely smooth. But I think if you could educate the family, let them understand why they're doing what they're doing, and why governance, like Martin said, and I believe, is the first thing you need to do, it makes it a lot easier. It gets trickier when you've got family members, and if two of the kids are really ambitious and one of the kids entitled, what do you do? It, unless you have governance in place, it's hard to do it.
Mm. One more audience question is, how are family offices integrating ESG considerations into private market allocations while maintaining performance objectives?
You want to take that one, Martin?
Ah, I don't know if I want to take this. So look, first of all, I'm not
I'll
an
take it.
ESG.
I'll take it.
Go
They're
ahead.
not. They're not. If you're going to be, look, I think, I know there's been studies, but look, if you're going the impact investing, it's driven from the younger generation up, not the older generation down, because they want to change the world, and I get that, and everybody wants to change the world, but um, it's very hard to look at something and say my investment's got to be a great investment, and it's also got to change the world. And a lot of these, I don't think the performance of these ESG funds, and a lot of it, there's a lot of greenwashing too.
You enabled me to take a breath here. So my response was going to be they don't. They do not take ESG
What I said,
considerations while maintaining performance objectives. There do exist family offices that take ESG considerations into account,
right?
but not while maintaining performance objectives. So the
Correct.
point is they don't have a framework. It's not like they say we're happy with 1.5% less returns per year as long as it's green. No, it's not. They make themselves believe that they can achieve both at the same time, but typically they can't. It's just
But
it's just an
my
impossibility.
argument, my argument to that, and I agree. My argument is fine. Don't do the ESG investing. Earn 2% more in non-ESG, and then donate to the philanthropy or the foundation the excess money you made by not investing in the ESG investment. It's not complicated. I think people will look. People try to. It's not a complicated thing formula.
It is one of the long list of answers Ron and I gave today that are very unpopular to hear. We should probably had a trigger warning at the beginning of this, that not that many of the things you will hear here are not pleasant to hear or something like that. No, but again, like the point is that there's an entire industry out there that is paid to tell you that you can do that and that you can achieve the performance objectives and the ESG objectives at the same time. No, so that's the problem with the lack of independent advice out there and the just
Well,
misaligned incentives in the system.
it's kind of I guess, just a generally interesting idea that in the past it was very much pitched that you could do this thing, that not only can you do kind of the good thing, but that the returns will be higher. And for a while that was kind of true because there was this big trend, and you even, you see investment into things like electric cars and, all sorts of green technologies. And there was huge government funding of that as well. And in a funny way, if you invest in that, you actually receive you've got that extra government funding wind in your sails. At the moment, that has probably changed. It's definitely changed in the United States. And I think in Europe, there is a reckoning where governments are sort of saying, we've made all of these sort of 2030 commitments, and it's now looking like it'll be very expensive to make this happen. But equally, I feel that if an investor, if a family sort of feels that they want to do, if it's your goal to make the world better by investing in certain ways, I think that's right
That's
for you to
legitimate.
do that. But
Oh,
you shouldn't expect to be
exactly.
sort of double paid.
Exactly. So as Ron said a few times on this podcast, I'm not judging. I'm just describing what you're doing. No, so if your goal is to do green things, that's fine. I have absolutely no problems with that. If your goal is not wealth preservation, I have no problem with that. You can have all kinds of non-financial objectives in life we're just trying to warn, I think, against the, okay, now I'll say delusion, that people can achieve things that they can't. And that is both true for being in the top 5% of investors, and all the other 95% of our listeners are idiots, no? So this just can't, these things have to add up at some point in the aggregate, no? So, and this is, I think, what Ron and I are attempting to
Yeah.
bring on the
Well, hold
agenda.
on. Isn't delusion even harsher than ego?
All right, I got carried away.
All right. I'm just
Well,
trying to.
this, for some reason, our audience questions all link together awfully well. Because the final question, which sort of relates to the last one, is how do you address different values and priorities across generations?
There's no right. First of all, there's no right answer. You have to have. That's why governance, what Martin said, and I believe is so important. You have to have a mission statement. You have to have all these things figured out beforehand. What's important to the family, and it's going to be different for different generations. I mean, when I bought a pair of jeans when I was a kid, if it fit, I bought them, and if it didn't fit, I didn't buy it. I wouldn't buy them. My daughters, the jeans have to fit, but then they want to know who takes care, who creates them, how do they underpay their employees, do they pull it? They have all this information. I think the younger generation, they've got much more access to information than my generation. I had the Encyclopedia Britannica. They've got access to like this thing, and which I think is going to be the new
Hmm.
smoking, but that's another topic we could talk about later.
Yeah.
So again, I agree with that, and I want to just also use that opportunity to just reflect on. In this podcast, we talked a lot about investment strategies and what to do in order to preserve wealth and all these good things. But like, it is far from me to judge anyone who has different objectives, no? So if the objective is to do good in the world and buy a national park, then of course that is or unlikely to have the same financial returns, but that's also not the objective. And the foundation of any good family office in this process Ron described of what should one do after selling the company is indeed to get the family together, run a workshop, talk about what the objectives are, how much money one actually wants to retain, and what that implies for the investment strategy, right? Because there's no good end for a family in having the investment strategy and the governance of the family office misaligned with what the values are and the priorities are for the various generations. So this is really the foundation for everything. And everything we've said here is under the presumption that the goal is to preserve the wealth over the generations, as opposed to, having non-financial goals.
Now, the final question, I'll have to close to questions after this one, comes from Sandra, and the question is, where does philanthropy come into play in the calculations of a family office?
So I'm very big. This is my North Star. So I think, look, we're living in a society where, certainly in the US, the wealthy are getting wealthier and the poor are getting poorer. And without a sustainable middle class, bad things happen. It's just not good for society. Having said that, what I am optimistic about is I think this next generation, they do, in general, they do care. My father passed away from prostate cancer at 57. My first boss was Michael Milken. He developed prostate cancer. What my dad did is he went to three, four doctors, second, third, fourth opinion. He lived 4 years, and then he passed away. What Milken did is he built it like a venture capital firm. He put 250. He went to the doctors, but he went to put $250,000. This is a crazy idea. 5 million here, 3 million here, and up to 100 million. And because of Michael Milken, all three of us will die with, but not of, prostate cancer. Fast forward 30 years, irrespective of what you think of Bill Gates, I would argue he did more for COVID than the U.S. government. Sergey Brin has predisposition to pancreatic cancer, and he's donated $1 billion. Is he going to solve it? I don't know, but I put my money on him over the American Cancer Society. So my point being that I don't think it's a panacea, but I do think family offices um, are going to, they're not going to solve all the world problems, but I think a lot of the problems are going to get solved because it's not going to come from governments. Governments typically aren't that good at it. I don't think it's going to come from corporate, but all of us have been touched by something. I've been touched. My mom's got dementia, so that impacts me. My dad died of prostate cancer. That impacts me. So you take these entrepreneurs with all this money and you run it more like a business. I think that's what's going to happen, and I think these philanthropies will get more efficient. Martin, what's your thought?
I thought I had nothing to add to this, but Novo Nordisk is a foundation, no, that got started by an entrepreneur 100 years ago that now is developing amazingly important drugs and is either Europe's most valuable company or among them. So I guess that just substantiates your point. But other than that, I don't have anything to add to philanthropy.
Well, I guess we're about out of time at this point, so I'll thank everyone for attending. Thank you, Martin, and thank you, Ron. And also thank you to the private markets group who organized this, and to all of the attendees and viewers who are watching online. Hopefully you guys found this interesting, and I guess we'll wrap up with that. Does anyone, Martin or Ron, do you have any sort of wrap up comments or?
Yeah, why is cricket a sport? What is it? It doesn't make sense. I'm looking at it from I grant you people are going to be bashing the Americans, and I'm not taking responsibility. It doesn't seem like a sport.
Ron, I'm not English. I just work there. So
I
And
understand.
I'm Irish, and so I'm hugely offended by the existence of English sports as well. So I think that's really, I think if we've solved one problem today, it's that British baseball or cricket, as it's called, should be stopped right away.
I think we're having violent opposition, even more so than to our contributions on investing. Thanks very much, Patrick, for doing this. Thanks, Ron, for
Yeah,
being here.
thank
And
you,
thanks to
Patrick.
Private
Martin,
Markets Group.
always great to be with you, Martin.
Thank you.